All right, let's dive right in. Today, we're going to master a tool that looks simple but is incredibly powerful for your trading, the Parabolic SAR indicator. We're not just going to cover what it is, we're going to build a full-blown strategy for smarter entries and exits. So let's get to it. Have you ever been staring at your charts, just wishing you had one indicator that gives you clear, easy-to-read signals on when to get in and out? Something that helps you ride the trend without cluttering up your screen? Well, if that's you, you're in exactly the right place. So here's our game plan. We'll start with the absolute basics of what Parabolic SAR is. Then we'll talk about a huge mistake that trips up so many new traders. From there, we'll build a solid strategy for trading with the trend, a much smarter way to exit your trades, and even an advanced technique for spotting top-tier setups. And of course, we'll wrap it all up with the key takeaways.
All right, first things first. What in the world is this indicator, and how does it actually work? Let's get the fundamentals down pat.
You know, the name really says it all. Parabolic Stop in Reverse, or just SAR. It's built to do two things really well. First, to figure out which direction the market's momentum is heading, and second, to signal potential spots where that momentum might be about to flip. It's a classic trend-following tool, through and through.
And the beauty of it is just how simple it is to read. It's all about the dots. If you see the dots printing below the price candles, that's a clear signal for an uptrend. And if those dots flip to appear above the candles, well, that's telling you we're in a downtrend. It's about as clean and visual as it gets.
But there's another layer here that's super important. That space between the dot and the price, it's not random. When those dots are really far away from the price, that's a sign of strong, healthy momentum. But as the trend starts to run out of steam, you'll see those dots get closer and closer, almost like a warning that a reversal could be coming. Okay, so it seems simple enough, right? Dots are below, you buy. Dots are above, you sell. But not so fast. This way of thinking leads us right into the single biggest mistake that gets so many traders into deep trouble. This is that famous and, yeah, deeply flawed strategy. It's so tempting because it feels so simple. You see a dot flip, you jump in. But if this is your entire strategy, you're basically walking right into two major account-draining traps. So here's trap number one, ranging or sideways markets. You have to remember, Parabolic SAR is a trend indicator. When there's no trend and the market is just chopping back and forth, the SAR is going to flip and flip and flip, giving you one false signal after another. It's what traders call getting whipsawed, and it'll just bleed your account dry. And here's the other huge blind spot, completely ignoring the bigger picture. Let's say you get a sell signal from the SAR. That signal is pretty much useless if the market is in a massive, powerful uptrend. Trying to fight the main current like that is one of the fastest ways to lose in trading. So, how do we fix this? How do we filter out all that noise and avoid these traps? Well, we bring in a teammate. We combine the Parabolic SAR with another indicator that will act as our trend filter. And this one simple addition makes the whole strategy so much more reliable. And the solution is the 200-period exponential moving average, or 200 EMA for short. Think of this line on your chart as your North Star. It tells you the direction of the real long-term trend. It tells us which way we should even be looking to trade in the first place. So our new and improved process has three simple steps. First, you look at the 200 EMA. Is the price above it? Great. Then we are only looking for buy signals. Is the price below it? Okay, we're only interested in sell signals. Second, we wait patiently for the Parabolic SAR dots to agree with that trend. And third, only when both of our indicators are on the same page do we even think about entering the trade. This simple filter is a total game changer. Now that we've got a really solid entry strategy, let's talk about the other half of the puzzle, getting out of the trade. Because let's be real, a good exit is every bit as important as a good entry. Now, the common way people exit is they just wait for the SAR dots to flip to the other side. But look at the risk there. By the time the dots actually flip, the price is often reversed pretty hard, and you've given back a huge chunk of your profits. The smarter way is to use the SAR dot itself as a dynamic, trailing stop loss. As the trend moves in your favor, that dot moves right along with it, locking in your gains and protecting you from a sudden reversal. So what about our profit target? Where do we take our winnings off the table? A great rule of thumb is to aim for a reward that is 1.5 times your risk.
So you simply measure the distance from your entry point to your stop loss at the SAR dot, multiply that by 1.5, and that's where you set your take profit order.
And here is a crucial piece of advice for managing your risk. Sometimes the SAR dot will appear really, really far from your entry price. This means your initial risk is just too big. In those cases, you have two choices. Either you just skip the trade altogether, or you manually adjust your stop loss to a level that fits your personal risk comfort zone. Never, ever risk more than you're truly willing to lose. Okay, so once you've really mastered those basics, there's an advanced technique you can use to find some incredibly high probability setups. Let's talk about trading divergences. So what is a divergence? It's when your price chart and your indicator are telling you two different stories. For instance, the price might be pulling back a little bit, making a new low, but the SAR indicator is actually showing that the underlying momentum is still strong. This disagreement, this divergence, is a massive clue that the main trend is probably about to continue with force. This table breaks it down perfectly. For a bullish divergence, a sign to buy, you'll see the price making higher lows, but at the same time, the SAR dots are making lower lows. For a bearish divergence, it's the opposite. The price makes lower highs, while the SAR dots are pushing up and making higher highs. Spotting these patterns is a serious edge. And here's the exact playbook for trading it. Step 1, you spot the divergence. Step 2, you don't just jump in. You wait for the SAR to flip back in the direction of the main trend. That's your confirmation. Step 3, you enter the trade. And step 4, you manage it, just like we learned. Set that stop loss at the SAR dot and aim for a profit target that's 1.5 times your risk.
Phew, we have covered a ton of ground, from the absolute fundamentals all the way to an advanced strategy, so let's put this all together and boil it down to the most crucial rules you need to remember. All right, if you take nothing else away from this, remember these rules. First, never use the parabolic SAR all by itself. Always pair it with a trend filter like the 200 EMA. Second, only take trades that are going in the same direction as that long-term trend. Third, use the SAR dot as your smart, dynamic stop loss to protect your profits. And finally, if you want to find those A-plus setups, keep your eyes peeled for those powerful divergences.
So look, we've just laid out a complete trading framework, from finding a trade to getting out of it. But the indicators and the rules, they're just tools. The real question is, how are you going to take this kind of structured approach and use it to build the trading discipline that truly separates the successful from everyone else? That's something to really think about. Thanks for joining me.